So when we think about the fixed income landscape today, there's no doubt that we've been through a pretty amazing period of time over the last decade plus where duration was really a friend. And I think we're about to enter a new regime, at least here in the US. I think the overseas markets, we've got some time, so you don't need to be as concerned about rising rates in Europe and Japan and some markets like Australia. But in general in the US, we're going to go, and I think it's a good thing that we're about to go into a period where rates are going to rise a little bit. And some of this is already being reflected in prices. It's being reflected in the forward market, so this is not a surprise to the bond market, but I do think that if you're looking for income, you need to reposition a little bit. And the obvious answer is be shorter in duration, but I think in the spread sectors like high yield and the riskier segments of bonds, I really think if you haven't done so already, it's the time to go much shorter duration and think about bonds that you want to hold to maturity. Because if this rate hike cycle does create some big redemptions, I think you're much safer in that part of the spread sector than in the longer duration down in quality. So we think there are some good opportunities outside the U.S., in part because they're at a different stage in the cycle. So there's definitely divergent policy out there. We're at the cusp of a heightening cycle in the U.S. I think you got a ways until you have to worry about rising rates in Europe and in Japan and Australia. So have a look at some international REITs. So we aren't big fans of U.S. REITs, but non-U.S. REITs. You don't need to worry, I think, about a big movement up or a rate shock overseas, and you get some good pickup in yield. So that's an example of a market that we like. I think European equities, after Greece is resolved, or put that differently, I don't think Greece is going to resolve. I think it's going to get kicked down the road, which is the European pattern. But once the news dies down a little bit, I think people will come back and focus on a lot of the catalysts and a lot of the quantitative easing that's supportive of European stocks. So there's some great dividend yield opportunities there as well. So I think we've pared back. We're anxious to try to put more money to work in Europe once we get a little more clarity around Greece.